Okay, students. So, in days 101, practical problems we have seen how the migration to happen and all. There are some theoretical chapters. Okay, theoretical important questions. Please focus. If you see this question, this is a 12-mark question which has come in your MTP, RTP, and it has been updated in your new syllabus. Now, HIM Limited is having net worth of 250 crore, and they have to adopt from 1st April 2012 as per company's Indian accounting standard rules. Okay, this is your transition date. Rahul, the senior manager of HIM, has identified the following issues which need specification of the CFO so that the opening balance sheet on the date of transition can be prepared. Like we have already prepared on the transition date, correct? No? Adjustment to the retained earnings and all. We have done that. So now you have to go through this and tell me how you are going to address this. The PP has been, as part of the PP, company has elected to measure the land at its fair value and want to use the fair value as the deemed cost on the date of transition. Can they do it? Yes. Then what you need to tell? Do it for all. Do it all means not fair value, retrospective for all. Otherwise, take everybody's as a deemed cost. The carrying value of the land was 5 and it was acquired for a consideration of 5 because it must be kept at the same cost. However, fair value was 8. If that is the case, what accounting entry you are going to pass? 2. Yeah, this is what we have done in that, but here in this problem they are telling it's revaluation surplus. In one question they have done, but that reconciliation question they have taken to retained earnings, no? And it has come for the exam also. So you remember, you see, worst case you can do with your assumption, otherwise worst case if that comes, do as per that. Now under Ind AS, the company has designated a mutual fund at FVTPL. There was one mutual fund investment. The value of the previous gap is 4 lakh at the cost. However, the fair value of the mutual fund on the date of transition is 5 lakh. Now under Ind AS it is FVTPL. Previously accounting standard what you did? At the cost. Can you shift to FVTPL? Yes, obviously. What accounting entry is going to come now? Investment to retain. Which one? This was 7 lakh. How it, then you must have been following revaluation model, no? Here 5 means you must have been following carry cost model. You remember 4 columns. I told you previously cost, new also cost previously. So don't worry. The chances of this question coming high is this, and we have seen all the places where they have used the cost only and they have transferred one problem retained earnings. Here we will transfer to, I think, revaluation surplus. Revaluation surplus. So you can take this stand, not an issue. Company had taken a loan from another entity and it carries 7% interest, incurred certain transaction cost, and it was carried in cost in the original recognition. It was carried at cost on its initial recognition. Principal payment should happen on equal installment. Interest also payable every year. The fair value of the loan is 1.8 against its book value of 2 lakhs. You remember there was one transaction cost. Retrospectively you can go and change. Okay, otherwise you have got the fair value. You can take the fair value. Now the company declared a dividend of 30,000 last financial year. On the date of transaction, declared dividend has been already deducted by the accountant from the reserves and surplus under the head provisions. The dividend was only declared by the board and not approved by the AGM. Reverse this. The company acquired intangible assets trademark amounting to 2.5. It has got indefinite life of the assets. The fair value of the intangible assets was 3 lakh. However, the company wants to carry at 2 lakh 50 only. Can they do it? Yes, one of the problem we have come, no, that big problem. Intangible asset they don't want to touch. PP they can do the fair valuation. After consideration of the possible effect, the deferred tax impact computed as rupees 25,000. This amount will further increase the portion of deferred tax liability. So what is the accounting entry? Your liability is going to increase and retained earnings is going to hit. There is no requirement to carry out separate calculation. Okay, I think this is a miniature version of that big question there. Management wants to know the impact. See, now prepare an Ind AS impact analysis report extract. So we need to learn how that should be prepared, which is a new learning for you. So that they will not do that soft Bharati or some last Shaurya limited problem. They may ask you prepare a report. They are required to discuss corresponding with the preparation Ind AS balance sheet against identified issue for preparation of the balance sheet. Also pass the journal entry for the issue of the issue. So how this impact analysis report will look like? That's whatever you have seen, no. You have to pass one rectification entry also. Yes. So the impact analysis report will look like this. So you give the heading called the preliminary impact analysis report, because this should be submitted to the board of directors. Now when you give, you cannot simply write some, scribble something and give. No, give in a proper fashion. You say that issue number 1, cost of PP. Accounting standard says what? It says recognize at cost. Under Ind AS, what you want to do? You want to take it on a fair value basis as a deemed cost. Impact, yes, company has decided to adopt the fair value. Since fair value is more than the book value, there is a 3 lakh rupees increase. So your accounting entry will be PP to evaluation surplus. So this format you need to answer if it comes. You don't answer in any other format. Each of this will carry your mark. So you need to tell what was there in accounting standard, what the Ind AS 101 says, and under Ind AS 101 what we want to do. Do we want retrospective? Do we want prospective? And because of our choices, what impact is there in the P&L or retained earnings? And what is my journal entry? Are you clear? Yes, Sana? Now issue number 2, fair valuation of the financial assets. Under accounting standard, you must have showed lower of cost or fair value. Maybe under accounting standard it was shown like that. But under Ind AS, financial assets are measured at fair value only, except subsidiary, associate or joint venture which are recorded at cost. So in the given case, as per 101, we want to designate FVTPL and increase to 1 lakh. So the increase is going to hit your retained earnings. So your accounting entry will be investment in funds, which are fund to retained earnings. Third, transaction cost. Accounting standard says charge the transaction cost to P&L account or capitalize it, as the case may be. You decide it. Ind AS says that, look, you have to amortize it with the loan. But if it is impracticable for you to retrospectively calculate the effective interest rate, you can start with the fair value of the liability on the transition date can be your fair value. Have we done this working in Shaurya also? Yeah, they said no, management I cannot calculate retrospectively. So what is the impact? Yes, the impact is your loan value is going to come down because fair value is only 1.8. So it's going to hit your retained earnings. So borrowings account debit to retained earnings. Proposed dividend, as per AS, provision was made in the year in which it is declared and approved. But Ind AS says it is recognized only when it is declared and approved. I don't know, then that accountant must have made a mistake. Accounting standard also says provision for dividend is made in the year in which it has been declared and approved. As per 109, liability for proposed dividend is recognized in the year in which it declared. It means it is not a subsequent event. But accounting standard, God knows how they have done that. Impact, yes, you have to reverse it and it is going to hit your retained earnings. Intangible assets, as per accounting standard, useful life cannot be indefinite. The company shall amortize it on a SLM basis for maximum 10 years. This is what your accounting standard says. But your Ind AS says, look, you can have assets with the indefinite life, but every year you have to test for impairment. So the company can avail the exemption to carry its book value. Okay, so if you want to carry out the previous book value, company intends to use the previous carrying value. So there is no impact on transition. That means my previous balance sheet value will become my new balance sheet value. There is no journal entry required only. Deferred tax, yes, accounting standard says income approach, we will go with the balance sheet approach, and because of all these adjustments, what we have done at the top, there is one increase in the liability. So we'll hit retained earnings and debit credit liability. Have you clear? Nice question, highly probable question. So you should be able to answer this. Sorry? No, they didn't. They asked one new word called impact analysis report. Revaluation surplus, because it's a revaluation. No? You have opted for revaluation mode. That they're done in one problem, but in other problem they have taken to revaluation surplus. Right? Revaluation. Which one? We could have followed this one method, see, but leave it. Yeah, we could have followed revaluation, but if you get that reconciliation, no, please follow retained earnings. Only for reconciliation. Everywhere else you consider it as revaluation. Now A Limited has a subsidiary. Okay, this has come in your MTP. A has got a subsidiary. A is a parent here. Now on the first time adoption of Ind AS by B Limited, it availed an optional exemption of not restating past business combination. However, A in its consolidated statement decided to restate all the business combinations. Parent said, I will restate. Now subsidiary had got sub-subsidiary, but when they adopted Ind AS, they didn't restate. Now whether the amount recorded by the subsidiary needs to be adjusted while preparing the CFS of A Limited, considering A does not avail the business combination exemption, will the answer be different if A Limited adopt Ind AS after B Limited? Like for them, what they are asking, your parent is the first time adopter. Now subsidiary was already into Ind AS by the time you came. Standard says, look, take subsidiaries book value. If they have taken that exemption or not taken exemption, leave them. Again, at this point of time, they don't make them to do something different. But subsidiary is not going to, you have become Ind AS compliant. Your subsidiary is not following Ind AS. And now after you, if subsidiary is going to become getting into Ind AS, you restate them. You cannot, at a group level, you cannot carry something different. So they say that entity first time adopter may elect to apply 103 retrospectively. If they restate any one, they restate all. Based on the above, A Limited restated the past combination. Ind AS 101 says that if entity becomes first time adopter later than the subsidiary, so on the date of transition of the parent, they can simply take the carrying amount of the subsidiary. Otherwise, see, already they are into Ind AS. If you tell them restate now, see, for the simplicity's sake, they opted, I will not restate. You B. After 2 years, your parent came into Ind AS and say, okay, 2 years back, whatever values are, then we restate. It's going to create a lot of accounting stress. No much value addition here. So they say that, look, don't get into it. If they are yet to do, make them restate. Not done, you take the carrying amount. Where the parent adopts later, it does not change the amount already recognized. Okay, this is like an exemption given. It's like a practical expedient. Then obviously, if I restate, you also have to restate. Just remember, see, why I am discussing it, there are more questions. I want you to do self-study. But these questions, since RTP, MTP and all have come, I will consider important. ABC government company is a first time adopter. As per previous gap, contribution received from ABC Limited from the government, in which 100% shareholding is in the nature of promoters' contribution, are recognized as a capital reserve and treated as a shareholders fund as per AS 12. Does it sounds like you have seen this question? It was there, no, in government grant. Then we said this type of adjustment was there in the AS 12, but in AS 20 is not going to speak about this. Then I told you one sentence there. The extension of the question you are going to find in 107, 101. State whether the accounting of treatment government grant is correct. This part of the question is the same answer of Ind AS 20. Now, if not, then what will be the account treatment on transition? Now comes 101. Followed, no? So, is that treatment permitted? No. You say that it is not permitted because Ind AS 21 says, if your government, see, there is a very thin line between the government himself is the owner, whether you have contributed as a grant or equity, very difficult. So it should be, if the ABC is a government company, so you have to decide which capacity they have given. 20 does not deal with the government ownership, it is dealt by 109. So in 20, you have got two classification called asset grant or income grant. You don't have something called a capital grant or your revenue grant and all, not there. So where it is concluded the contribution is in the form of government grant, apply 20 and do deferred income. If it is Ind AS 20 requires grant to be recognized on a systematic basis. If it is in the nature of the shareholders contribution, classify as an opening Ind AS balance sheet, where it is concluded that the contributions are in the nature of shareholder contribution. That means it is in the nature of equity. This is the second part of the question. Then what you need to do? You have to reclassify, because there is nothing, no. If it is the shareholder contribution, it cannot sit as a government grant there. So move it to the respective place. Accordingly, in the given case, contribution is in the nature of capital reserve, should be appropriate category of other equity. 1 minute. So first part of the question, as unlike AS 12, grant to be classified into capital or income. That's it. Okay, I think this part of the question is equal to Ind AS 20. Now they asked you, if not, that means if the treatment is not same. Yeah, we said correct, treatment is not same. Treatment are different. What will be the accounting treatment? Now they say that if you say the contributions are in the nature of a government grant, then you have to apply Ind AS 20. So Ind AS 20 requires you to treat it as a deferred income. So if you are treated it as a capital income, shift to deferred income. And from next year, comparative year onwards, charge to P&L. If it is concluded that it is a capital income, capital contribution, then you have to reclassify in opening Ind AS balance sheet and take it to other equity. I don't know where you have shown capital reserve, but capital reserve has to be shown under the appropriate lines. There are so many lines, no? You create under appropriate lines of your other equity. That's it. Even the capital reserve or whatever, you see what your law has permitted. See, again, accounting standard cannot tell you that, no? Now, which reserve heading and all, that your Companies Act should tell. Otherwise, see, dividend and all important. No, either I will transfer this to my retained earnings and from there I pay the dividend. Who will listen? It's a violation of the Companies Act. Are you clear about this? G operates oil exploration production facilities, preparing transition date opening balance sheet. There is a significant decommissioning obligation in connection with the several oil well, but previous gap did not require obligation to be recognized. God knows, it's their own theory, I think. What are you going to do? You have to recognize. How? Debit to PP, credit to decommissioning liability. So you say that when you have got a decommissioning liability, retrospective application of Ind AS 37 require management to recognize the provision of decommissioning liability on the opening Ind AS balance sheet. The provision should reflect net present value to settle the obligation. So the obligation should be capitalized as a separate component of the PP, together with the accumulated depreciation from the date when the obligation was incurred till the transition date. So that means it's a retrospective. Go back. This amount to be capitalized as part of the cost. So what accounting entry you will pass today? You see, 4 years back, if this liability, when I set up the asset, 20 years down the line I have to pay. What was my liability 4 years back? From there you start doing what's called unwinding of the discount. You come and check what was the balance today. You pass one accounting entry, PP account debit to decommissioning liability. And this you take it as a separate asset, and you may do the component accounting calculated by discounting liability using the best estimate discount rate. The associated accumulated depreciation is calculated by applying the current estimate, because if you would have added on day one, there would have been increase in the depreciation that you would have done. Any difference would be adjusted to the retained earnings. So this is a theoretical question. Maybe it may come. Your job is to go back to that 4 year, pass this entry then, and check how much would have been my depreciated value, how much would have been my PPE value, or this decommissioning value, and you pass the entry PPE account debit, decommissioning liability. It's the same, students, just like 116. PP is nothing but ROU, lease liability is nothing but your decommissioning liability. And there were 3 approaches in 116. It's called a full retrospective approach. First, that's what they are talking here. Not that modified alternative approach. That whatever you have done, you have to do it here. The entity could elect deemed cost exemption also alternatively. PP would be restated to the fair value. Management would need to ensure fair value was obtained through a gross value and not net of decommissioning obligation. Management would recognize provisioning for decommissioning as per Ind AS 37. No cost in respect of provision will be added to PP, should be recognized in the retained earnings. So, if they have opted for fair valuation, you have got a fair value with PP, then no retrospective. If the PP is fair valued, it is a gross fair value. If that is the case, then again you cannot add to the PP because PP is already hit with the decommissioning liability. Then your accounting entry will be retained earnings account debit to decommissioning liability. If you opted historical cost, retrospective, it would have been like this, fair value would have been like this. Okay, then last question. While preparing, clear notions, previous one. Yeah, chances are very low. While preparing the opening balance sheet on the transition day, recognize all assets and liabilities whose recognition is required by Ind AS. Entity is required to recognize all assets and liabilities, reclassify certain items that is recognized as per previous GAAP as one type of asset or liability, but different type of assets and liability, and apply Ind AS measuring all recognized liabilities and assets. Give examples. This is the theoretical version of, you have done reconciliation. In that reconciliation, have you written derecognize, reclassify, remeasurement? They are asking, can you give some examples what may come there? That means recognize all assets and liabilities whose recognition is required, like as per accounting standard you didn't recognize it, but under new standard you have to recognize it. Do you have any example? Just now we did, no, decommissioning liability. Intangible assets, certain intangible assets were not permitted. Ind AS says recognize it. Which one? Government grants. Certain things will come now. Now they say reclassify. Do you have an example? That previously you put it somewhere else, now you will put somewhere else. Preference shares, redeemable preference shares. Previously it was equity, you will classify. Apply Ind AS in measuring all recognized assets and liabilities. Apply Ind AS in measuring all recognized assets and liabilities. Okay, we'll see what examples are there. Are you clear? No? So this, they say you have to give example like customer intangible assets, share based payment, deferred taxes. Reclassification will be redeemable preference shares, NCIs. Previously it was negative balance, you would not have recognized. Negative balance of NCI might have been there. They would not have a minority interest. So now even though it is negative, you have to recognize. And apply Ind AS in measuring all recognized assets and liability like discounting of long-term provisions, measurement of deferred income taxes for temporary differences instead of timing differences. Okay, anyhow, one new word. Again, chances are very low. I gave this because it was very similar to that reconciliation issue. Yes, so these are all the 5 questions. Please focus. And that first question is very important. Part 2 theory is there. After this, if you find time, you can check. Yes, students. So okay, so thank you very much for this chapter also we have completed.